guys, it's Chad Larson with MLD Wealth, and this is MLD's August market update. This segment is going to be titled 8 Seconds. So, the cold open is, I want to talk about the rope. Stampede wrapped up a few weeks ago, and I want to start there because I've watched something that's been rattling around my head, ever since I sat through it up close. The thing that you get in bull riding isn't just 8 seconds, it's the 10 seconds after. Because here's the mechanics of it. The rider isn't just sitting on the bull. He's got the rope wrapped around his hand, cinched, sometimes tacked down with rosin so it won't slip. The rope is the whole thing. It's what lets him stay on. It's what turns a guy holding on for dear life into an athlete scoring points. And it's also the thing when the ride goes wrong, won't let him off. They call it getting hung up. The rider's off balance, off the back, and the hand won't come free. And now he's not riding the bull anymore. He's attached to it. Same rope, same amount of leverage, completely different outcome, depending entirely on which way the animal is going. I've been thinking about that rope a lot this summer because right now there's over $1.5 trillion of borrowed money sitting on top of this market, and almost nobody is talking about it. So this is Money Matters. I'm Chad Larson, and we're going to get into it here. So late innings. Let me set the table on where we actually are because I think the framing matters more this month than the day-to-day tape. We are in the late innings of a secular bull market. Not a cyclical rally, a secular bull. The long, multi-decade kind. This one started in March of 2009 out of the wreckage of the financial crisis. That makes it about 16 and a half years old. And here's the fact that stopped me. By next month, by September, this bull market matches the length of the 1982 to 2000 secular bull market, the one that gave us the greatest wealth creation of the modern era, which ended in the dot-com bubble. And we're about to tie that record. Now, late innings is not a sell signal, and I want to be really clear about that up front because I'm going to spend the next half an hour plus talking about risk, and I don't want anyone hearing a crash call. It isn't one. Innings can go long. If you called it late in 1997, you would have been technically correct and financially wrong for 3 more years. Nobody rings a bell at the top. The timing of a secular shift is genuinely unknowable, and anyone who tells you they've pinned the month is selling you something. But late innings change what good decisions look like, and the checklist for what a late-stage secular bull looks like is remarkably consistent across 100 years of market history. I recently sat through a presentation, and I thought it was the cleanest articulation I've seen this year. And run through it with me. Narrow market leadership, check. Extreme index concentration, check. Stretched valuations, check. The cyclically adjusted price to earnings of the S&P is north of 40 times in 145 years of data. We haven't been in that neighborhood. Exactly. We've been in that neighborhood once, and it was 1999. Everyone crowded into a single prevailing narrative that drives sentiment. Check. I don't think I need to tell you which one. Robust IPO activity driven by optimism rather than fundamentals. Check. Retail exuberance, extrapolation bias, gamification, and leverage. Check, check. And we're going to spend a whole segment on the third one. So here's the one I find hardest to argue with. Since ChatGPT launched in late 2022, the market capitalization of US tech stocks has gone from about 44% of American GDP to roughly 101%. In under 4 years, one sector went from half the size of the economy to larger than the entire economy. This is not a moral judgment. Technology is eating the world, and I own plenty of it. But when one theme grows to that scale, it stops becoming a sector call and becomes the market. Your diversified index fund is not as diversified as the name in front of it suggests. So that's the frame, not the get out. The frame is the thing that worked for 16 years. Buy the US index, own the biggest names, don't think too hard, is the thing that is most exposed if leadership rotates. And leadership always rotates eventually. The question is usually what triggers it, and history's answer is pretty specific. So The capex cycle, how these things actually end. Secular regimes don't usually end on a headline, they end on a capital spending boom. That's the pattern. Late in a cycle, the dominant narrative gets so convincing that everyone starts building enormous, simultaneously competitive capital investment, all justified by a demand forecast that is genuinely reasonable at the time, and the spending itself becomes the story. And we've been talking about that. The the hyperscalers capex announcements and build out is the equivalent of US government stimulus. So here's the mechanics that matter, and it's the single most useful idea I've picked up this year. One company's capital spending is another company's revenue. And think about that for a second. When a hyperscaler spends hundreds of billions of dollars on data center, that shows up as revenue at the semiconductor company and at the electrical equipment company and at the mechanical contractor and at the turbine maker. Their earnings look spectacular, their pricing power looks structural, their multiples expand. But it's the same dollar. It's one participant's balance sheet decision landing on another participant's income statement. And that creates temporary distortions in revenue, in earnings, in margins, distortions that the market has a long history of extrapolating as if they were permanent. Then one of things two happens. Either the capex boom becomes a capex bust, the spending stops and the revenue vanishes, or the spending continues, but the return on it doesn't show up, and the market re-rates the whole complex anyways. We've seen this movie repeatedly. Railroads in the 1870s, telecom fiber in 99 to 2001, when the demand forecast was actually correct, and the equity holders still got wiped out because everyone built it at once. And closer to home, energy from 2007 to 2014, a multi-year capital spending boom, companies raising equity every 6 to 12 months to fund development, debt piling into the cap structure, returns declining even as commodity prices rose. That one ended badly, enough to send the energy sector that still hasn't been forgiven. 17 years later, we'll come back to that. Now look at today. Hyperscaler capital expenditure guidance for this year is somewhere north of $700 billion. That is roughly the entire GDP of Sweden spent on compute infrastructure in 12 months by just a handful of companies. And the market has essentially become a levered expression of that number. The work done on this is generally starting, and it's the chart I'd put in front of anyone who thinks they own a broad index. Strip the S&P down to its return contributors this year, and almost the entire return came from data center beneficiaries. Roughly 3% of the constituents, companies with a data center angle, that were up more than 100%, accounted for very nearly all of the index's gain. The other 97% contributed almost nothing. And it's not just the chip names. Go look at capital goods sector, the mechanical contractors, the electrical equipment makers, the generator companies, the grid builders. Nearly every one of the winners has a data center story attached to it. It's an old economy sector that has been re-rated as a technology derivative. So when people ask me whether I own the S&P 500, my honest answer is nobody owns the S&P 500 right now. You own a data center index in disguise. In July, we got the first real tremor. The memory names in Asia, Hynix, Samsung, fell double digits in a single week. Taiwan Semiconductor's capital spending guidance, which in another year would have been read as confidence, got read as overbuilt risk. There were reports of a hyperscaler with surplus GPU capacity looking to monetize rather than consume it, which, if you've built your thesis on perpetual scarcity, is a genuinely different signal. The Nasdaq entered its second correction of 2026, closing late July roughly 10% below its June high. Now, here's the part I want you to notice because it's the whole thesis in one number. While the Nasdaq was down about 10% from its high, the S&P was down about 4 and the Dow was about 3. That is not the market falling apart. That is the market rotating. Money didn't leave, it's moved out of the crowded, long duration, capex dependent end of the market and into the parts of the market that have been ignored for a decade. And now let me argue against myself because I think the bull case here is strong and I don't want to straw man it. This capex is not the telecom bubble in 1999. The fiber was built with junk debt by companies with no earnings. Today, the overwhelming majority of this spend is funded out of operating cash flow by the most profitable companies in the history of commerce. Cloud backlogs are enormous and still growing. The monetization evidence has genuinely improved over the last year. The revenue is showing up, which was the central bear argument for 2 years and is a much weaker argument now. And AI related spending is a meaningful share of the entire market's earnings growth. That's not a narrative, that's an income statement. So I'm not betting against the capex. I just want to be ambiguous about that. The two things that can be true at once, the spending can be real and the price can be wrong. A great company and a great investment are not the same thing. A business can be generational and the stock still depends entirely on what you pay for it. And if I'm looking for where stress shows up first, it isn't the income statement of the hyperscalers. It's the financing layer around the build out, the special purpose vehicles, the vendor financings, the private credit that's been quietly funding data center developers who aren't sitting on hundreds of billions of dollars of cash. That's the plumbing that we're watching. So what do you do with all of that? You don't short the boom. You own what the boom is forced to buy. And that's the whole halo idea we've been talking about. Heavy assets, low obsolescence, high replacement cost, scarcity value, power, grid, copper, gas, cooling, land. The stuff that has to exist regardless of which model wins, which chip architecture wins, or which company ends up with surplus GPUs. Be the skeleton here and not the muscle. So we talked a little bit last segment about anchoring to the high mark, and let's talk about what really this does to your head because I've had a lot of conversations this month about it. I've had the same conversation about 15 times in the last 3 weeks. There's a behavioral bias in behavioral finance called anchoring. It's simple. The first number or the biggest number that lands in your brain because of the reference point for everything that follows, whether or not it has any business being there. And investing, there are two anchors that cost people real money, and I want to name both. The first one is the high mark, the biggest number your statement ever printed. Your account touched a certain figure at some point in the year, and from the moment it did, that number became the thing you've measured yourself and me up against since that date. You're not comparing yourself to where you started or to what you need. You're comparing yourself to the peak, which means that even in a portfolio that's up substantially since you've invested, every single day below that high watermark feels like losing. You're winning by every measure that matters, but it feels like a slow bleed. And here's why that is so dangerous rather than just being unpleasant. Anchoring plus loss aversion is the exact chemistry that makes people sell at the bottom. Because the further you get below the anchor, the more the decline feels like a verdict on your judgment rather than an ordinary market fluctuation. And at some point, the discomfort exceeds the conviction and you liquidate. Or on the rebound to the new high, you sell before you miss the next leg. Usually within a few weeks of the low, I've watched it happen for over 20 years. It's the single most expensive habit in the business. The second anchor is subtler, and I think it's more expensive one right now. It's anchoring the rate of return. If you've earned mid to high teens annually for 3 or 4 years, your brain quietly reclassifies that from an exceptional run to normal and expected. And then you build your plan around it. You assume your retirement number arrives on that schedule. You take risk you don't need because the compounding math on a huge number is so much prettier than an average one or a realistic one. And the trouble is that validation is the single most reliable predictor we have of long-term returns. It tells you nothing about the next quarter. It tells you have a great deal about the next decade. And the historical relationship is unambiguous. When you start from valuations in the neighborhood we're in today, the annualized return over the following 10 years has clustered in low single digits and sometimes negative.
Passive index beta is positioned to underperform. That is not the same as saying the market's going to go down. That distinction matters enormously. I don't mean sell everything. It means the benchmark is unlikely to do the heavy lifting from here. And so your return has to be manufactured somewhere else in allocation, in geography, in style, in income, in alternatives, in the parts of the market that haven't been repriced, which conveniently is exactly what we've built portfolios around. So here's what I'd ask you to do, and it takes about 5 minutes. Re-anchor, not the high mark, not to last year's return, to your required return, the number your actual plan needs to work. What do you need to earn on the capital you have to fund the life you want? For most families I work with, that number is a lot lower than the ones that we've been achieving. And you know it, an enormous amount of anxiety drains out of the market because you stop measuring against a ghost and you start measuring against a goal. Your benchmark is not the biggest number you ever saw. Your benchmark is whether you get to retire the way you planned. And if you want the single most extreme version of what I've ever witnessed, hold that thought. I've got one for you in about 20 minutes, and it involves a fund that made 400% and is now being described as a catastrophe while still being up on the year. The next segment, it's unique. I'm calling it the casino in your pocket. All right, we've talked about what's going on in our head, and let's talk about what's going on in people's hands because something has happened over the last 18 months that I don't think we've properly reckoned with as an industry. The line between investing and betting has not blurred, it's been deliberately erased by product design. Start with headlines because that's the top of the funnel. We tell ourselves we live in an information age, and I'd argue we live in a headline age. And those are as close to opposites as they get. Information reduces your uncertainty about the world. A headline is engineered to produce a reaction. And the feed that delivers it to you, whether it's a social platform, a news app, or the notifications tab inside your brokerage account, is not optimizing for the first thing. It's optimizing for engagement, for time on screen, for clicks, which means it selects relentlessly for whatever is most arousing, not whatever is most true or most useful. So the volume of financial content you're exposed to has gone up 10, 20, 50 times in a decade, and the actual information content of that flow has gone up barely at all. It's the same 8 facts recut into 400 pieces of content, each one framed to make you feel like something is happening right now and you're late. More flow is not more signal. Past a certain point, more flow is just more noise pretending to wear a suit. And here's the practical damage. Every piece that flows implies an action. Nobody clicks on nothing has changed, your allocation is fine. The entire economics of the ecosystem require you to do something. So the flow generates a low grade permanent itch to trade. And the evidence on what frequent trading does to retail investors is about as settled as anything in finance. The more you touch it, the worse you do. That has been true every study in every market for 40 years. And the second layer is gamification. Let's look at the design language of a modern trading app and then look at the design language of a mobile game. Confetti, streaks, badges, push notification. When a name you watched moves, leaderboards, round numbers, big satisfying green digit, instant frictionless one thumb execution. None of that is accidental and none of it is neutral. Those are the variable reward mechanics, the same behavioral architecture that makes slot machines work. They're designed to increase the frequency of engagement, and frequency of engagement is exactly the variable that's inversely correlated with your returns. And then the product itself got faster. 0 day options contracts that expire the same session have gone from a niche institutional tool to a meaningful share of index option volume, and a lot of it's retail. And that is not a hedge. That is not an investment. It's a same day binary bet on the direction with a countdown timer attached to it, which brings me to the thing that actually made me want to record this segment, which is prediction markets. If you haven't been following this, the numbers are generally difficult to believe. Combined monthly volume across the two largest prediction market platforms went from under $5 billion in September of last year to roughly 24 billion by April, and then to about 45 billion by June. To put that into context, 45 billion in a single month is more than triple the average monthly handle of every legal sports book in the United States combined. And it's overwhelming sports. We're talking about Polymarket and Kalshi. These are less relevant in Canada as we don't have access to them as they're regulated. But I caution you to go look, but you can go bet on anything. In one of the major venues, something like 87% of trading volume in March came from sports events contracts. So let that sit for a second. The fastest growing financial market in the world by volume is a sports book. Now, I want to be fair here because there's a legitimate intellectual case for prediction markets. And I don't want to straw man it and say poo poo to it. The case is real. A market where people put money behind a forecast aggregates dispersed information better than a pundit does. Polymarket became famous during the last presidential election. Polymarket was more accurate to what was happening in politics than anyone left or right winged or conservative or democratic, polling. It was the people voting of what they thought was happening, and if they thought what was happening, it's because that's what they were going to do. The price is the probability, though, as a forecasting mechanism for elections, for policy outcomes, for whether a rate decision goes one way or another. It's genuinely useful. And I look at those prices. They are frequently better than the consensus of professional commentators, which tells you something uncomfortable about professional commentators. And the institutional world has validated the model. The parent company of the New York Stock Exchange put up $2 billion into one of these platforms at an $8 billion valuation. That's not a fringe bet anymore. So the mechanism is sound. My concern isn't the mechanism. My concern is the plumbing. The rails between your retirement account and a sports bet have been welded together. Because here's what's actually happened. These contracts are now distributed inside brokerage apps. One of the largest retail brokerage apps in the world put a prediction markets hub in front of tens of millions of funded accounts. Now, instead of betting, if you wanted to buy shares of Apple, you could bet to see which congressman won the next seat in a Senate race or whatever it might be, or if like you go on Polymarket, you could literally bet on if someone says the word rain on the weather. It's absolutely wild. Regulators pulled back proposed restrictions. The category is now sitting one tab away from your ETF holdings, and I feel that's dangerous. So the 28-year-old who opened up an account to buy an index fund to slowly fund his retirement and do all the things Warren Buffett taught us to do now sees in the same interface with the same balance, using the same one thumb gesture, a diversified portfolio, a 0-day option, a 3 times leveraged ETF, and a contract on a soccer match. These four things have been given identical visual weight and identical friction. And when the interface treats them as equivalent, the user starts to treat them as equivalent. That's not a character flaw in the user. We're human. That's what interfaces do. Here is the distinction I ask you to hold on to because it's the whole thing. Investing is just buying a claim on future cash flows produced by a productive asset. Over time, the pie gets bigger. You can all win. It is a product positive sum activity, and that's the single reason compounding works at all. Betting is taking a position on an outcome against a counterparty with a fee taken out in the middle. The pie is fixed and then shrunk by the vig. It is a zero sum before costs and negative sum after them. Somebody has to be wrong for you to be right. Both can be entertaining. Only one of them compounds. And what worries me at a market level is what this does at the top. Every one of the late stage checklist items we walked through in the first segment, the extrapolation, the speculation, the leverage gets amplified by a distribution system that is faster, more addictive, more leveraged, and more available than anything that existed in 1999 or 2007 or in 2021. The froth in those cycles took months to build. This one can build in an afternoon and unwind in an hour. So what do you do about it? Three things, and they're all boring, which is the point. Separate the accounts. If you want to trade or bet or take a swing, I'm not going to tell a grown adult not to, but do it with a defined amount of money in a separate account that you have decided on in advance what you can lose entirely. I cannot believe I almost sound like I'm giving Gamblers Anonymous tips online on a financial podcast, but here we are. Add the friction deliberately. Turn off the notifications. Check the portfolio quarterly, not hourly. Every piece of friction you put between the impulse and the trade is worth the money. And ask one question of any headline before you act on it. Does this change the cash flows of something I own over 5 years? Almost always the answer is no. And when the answer is no, the correct action is nothing. The last one is the hardest thing in the business, and it's the actual job. Most of the value we add for clients isn't the brilliant idea, it's the trade we talk them out of. So, the rope and the leverage in the system. Now let's go back to the rope from bull riding, and I want to start with the best illustration I've seen it in 20 years, which happened last Thursday. There's a hedge fund called Situational Awareness, and it has started a meme frenzy on the internet because, quite frankly, there was no situational awareness. But I want to sit with that name. It started in 2024. A young man named Leopold Aschenbrenner. He's a former open AI researcher, 25 years old, who wrote a widely read essay on how artificial intelligence was going to remake the economy, and then launched a fund to express exactly that. And here's the thing that people are going to forget in all the noise. He was right. Substantively, early, correctly right before almost anybody. He built a book around AI infrastructure, much like I run, that's done very well. Memory chip makers, data center names, cloud infrastructure. But then he used leverage to press it. Through the first half of the year, the fund was reported, like we're in August. Through the first half of 2026, that fund was up reportedly 439%. 439% in 6 months on a public equity book that reportedly reached about $16 billion of AUM. Then July happened. The exact sell off we walked through earlier, memory chips, data centers, the whole CapEx complex, a leveraged book concentrated in precisely that complex reportedly lost about 67% in a single month. So the fund lost almost 70% last month. The prime brokers made the calls. There was margin to be had. Privates had made their way into his book. The fund had to sell. And the buyer on a Thursday was Ken Griffin's Citadel, which is in its own lesson, which is its own lesson, honestly. Citadel's done this before. Amaranth's natural gas book in 2006, Sowood in 2007, the rescue into Melvin Capital in 2021. There's a reason Griffin is the phone number that rings at 2 o'clock in the morning, because Citadel is not the one making 400% in a market that goes up and to the right. Citadel is the one sitting on capital, parked by the exit, waiting for the day someone else has to sell what they want or don't want. Everybody is a genius in a top right market. The bill for that genius arrives on somebody else's schedule. So now I'm not here to dance on anyone's grave, and it would be very easy and very cheap to do so. He's 25 years old. He was right about the thesis. He made his investors an extraordinary amount of money before he gave some back. His cumulative return is something, it's over 2,000%. He wrote his investors a letter taking full responsibility, and he said the fund is done borrowing from banks to lever the public book. He'll be fine, and he'll probably end up better at this than most of the people currently laughing at him. And I'm not telling you this story because of him. I'm telling you because it is the entire episode compressed into one fund. There are three lessons in it, and they're the three I want most of you to walk away with. One, The hot hand is a fallacy, and leverage is how you find out. There's a well studied bias called the hot hand fallacy. We are pattern detecting animals, and a run of success reads to us as an evidence of permanent ability rather than a favorable regime. Basketball, poker, markets, it doesn't matter. We see a streak and we infer a skill. Markets make this worse than anybody anywhere else because if you're right and levered, the run is so spectacular that nobody, including you, can any longer separate skill from the regime. The scoreboard stops being informative at exactly the moment becomes the most persuasive. And here's the reported detail that will stay with me. About a week before the forced sale, he wrote to investors describing the sell off as one of the most attractive entry points in over a year and offered them the chance to add capital starting the 1st of August. This isn't stupidity, it's conviction. He may even turn out to be right about the entry point. The market has started to rally. My screen is wildly green today. But conviction and staying power are not the same thing, and leverage is what converts one into the other and in the wrong direction. He didn't get to find out whether he was right, and that is the entire point of this segment. Two, the herd was the trade, right up until the herd was the exit. Concentrated AI infrastructure was the most consensus position on the planet. Every fast money book on earth owns some version of it, and a crowded trade is fragile and a purely mechanical reason. When the marginal buyer has already bought, there's nobody left to take the other side. So the unwind doesn't happen gently. It happens all at once into a bid that isn't there because everybody who would have bought it is busy selling their own version of it. The herd is comfortable and the herd is warm, and the herd is also why the door is too small. And three, and this one I actually want you to take home. Look at what the number does in your head. Up 439%, down 67%. Run that math. Roughly speaking, the fund is still up somewhere in the neighborhood of 80% on the year. Saying it out loud, because it's absurd, on the year, the fund is reportedly still up something like 80% in 7 months. That's a career year for almost anybody in the business. And it is being described universally in every headline, probably by the manager himself, as a catastrophe because of the anchor, because everyone involved is measuring from the high mark instead of from the starting line. This precisely was what I was talking about 2 segments ago, and its most extreme imaginable form. The distance between one of the great runs of the decade and a disaster turned out to be entirely a question of which number you choose to measure it from. If it can do that to a professional running $16 billion, be honest with yourself about what it's doing to you when you look at your own statement. So I've told you the anecdote. Now let me show you this isn't just an anecdote. Margin debt. Money investors have borrowed against their securities in their own accounts, hit a record of roughly $1.5 trillion as of June FINRA data. $1.5 trillion on margin. But the level isn't the story. And I want to be careful here because the level always rises in a market. A bigger market carries bigger margin balances. It's arithmetic, not a warning. The signal is the rate of change, and margin debt has been growing roughly 49% year over year, vastly faster than the market itself has risen. The gap when borrowing outruns prices that match has historically been a late cycle marker. It ran hot before 2000, it ran hot before 2007, and it ran hot before the 2021 top. Then there's the other side of the ledger, which almost nobody looks at, which I find more striking. Free credit balances. The cash sitting in brokerage accounts, net of what's being borrowed, are at a record negative, on the order of negative $1 trillion. Read that plainly. In aggregate, the retail brokerage system has no dry powder. The cash has been deployed and some. The buying has been done with borrowed money. And layering on top of that, you've got a few $100 billion sitting in 2 and 3 times leveraged ETFs. instruments that reset their daily leverage, decay in choppy markets, and are held overwhelmingly by people who haven't or can't read a prospectus. And here's why this matters. And I want to be precise because it's not a moral point people usually make. Leverage does not cause the decline. Leverage removes the ability to be patient during one. And that's the whole thing. Every good outcome I've ever seen in this business came from someone being able to wait. Wait through the drawdown, wait for the thesis, wait for the re-rating. Patience is the actual product. Margin takes that away because when the position moves against you, you don't get to decide when you sell. A maintenance requirement decides, and it decides at exactly the worst tick alongside everyone else who's getting the same margin call at the same moment. And it's a vicious cycle. Forced selling creates lower prices, which creates more forced selling. That's how a temporary drawdown, which is survivable and normal and happens most years, becomes a permanent loss of capital, which is the only kind of loss that actually matters. And now put the anchoring and the leverage together because that is the combination that does the worst damage. The anchored investor holds too long because selling below the high mark feels like admitting defeat. The leveraged investor gets sold at the worst possible moment because the broker dealer decides, not him. Do both at once and you get liquidated at the lows while describing yourself as a long-term investor. Let me be fair to the leverage. I'm not a Puritan about it, and I'd be a hypocrite if I were. Borrowing against a portfolio done properly is a legitimate tool. Modest loan to value, a diversified liquid portfolio behind it, interest serviced comfortably out of income rather than out of hope, a defined purpose and a defined exit in the right circumstances, and deductibility considerations that make the after tax math work. We help clients use it, and it's fine. That is not what's happening in the aggregate data right now. And what is happening is that maximum permitted leverage applied to the most crowded, highest multiple, highest volatility corner of the market by people who have never lived through a real drawdown in the names they own. So, three questions. And if you're using margin or you're thinking about it, you should be able to answer all three without looking anything up. What is my maintenance requirement in dollars? At what portfolio level do I get a call? What happens to this count in a 30% decline? Not a 5% decline, 30. What gets sold first? Because it's usually the concentrated volatile position you are most convinced about. If you can't answer those, you're not using leverage, it's using you. So that's the rope. And it's what lets you score right up until the thing that won't let you go and tears you apart. So I'm gonna get off all the fun, like the kind of wild stuff of what's going on in the market and really set the table again on international equities being the main course. And we talked about where rotation is actually showing up because it isn't theoretical anymore. International equities, we flagged this back in spring, and I want to update it because the trend has extended rather than faded. Last year was the first year in five that markets outside of the US beat the US, and it was by the widest margin in about 3 decades. This year has continued it. Broad international benchmarks are ahead of the US again in dollar terms, which is remarkable when you consider that the AI trade led global markets for most of the first half. For 15 years, owning anything outside of America was a tax on your returns. Global diversification became a punchline, the thing your advisor made you do and resented you every January. That has flipped. And why matters because this isn't a 1 quarter head fake. Four things. The dollar. A weaker dollar is a mechanism, is a mechanical tailwind for a North American investor holding a foreign asset. It shows up in your return without the underlying stock needing to do anything. Valuation. International developed markets trade around 17 times forward earnings against roughly 22 times for the US. The gap has narrowed from its extremes, but it's still a meaningful discount. Composition. International indices are structurally tilted toward financials, industrials, materials, energy, cyclical, and value exposure. If leadership rotates away from long duration growth, those indices are more exposed to the winners. That's not a forecast. That's index arithmetic. Policy. Europe is spending real money. Infrastructure, energy, security, rearmament. Japan continues its governance reform and its slow normalization. These are multi-year budgeted policy anchored programs. So the honest counterparts in there are real ones. The counterpoints are some of them are real. So a lot of the easy money's been made. The discount is narrowed than it was narrower than it was 18 months ago. Currency is a two-way street. If the dollar catches a bid, and it can, a chunk of that return goes with it. So be cautious on your hedging. Europe's underlying growth is still structurally slow and cheap, and it's been a value trap abroad for the better part of 15 years. And emerging markets carry governance and geopolitical risks that you simply don't have in the S&P. On Japan specifically, the higher energy price we've been talking about has been a tax. It's a genuine headwind for a net energy importer. We saw the US Fed interject and help support the yen. Japan's a bit of a disaster right now. And it's the cost. And it's cost us some of the outperformance we expected. But I read that as a cyclical rather than a structural. Thesis intact, conviction unchanged, and we wait rather than chase. So where does it leave it? International isn't the hedge anymore. It's a driver, but own it deliberately by geography, by style, by sector, not by buying a broad developed markets fund and closing your eyes. Europe on and working, Japan patient, emerging selective. Having multiple horses in the race is paying off again. I don't think that reverses quickly. I'm going to touch on gold and why I'm continuing to be bullish more than why it's on its highs. And I want to do this one carefully because I'm not going to tell you I'm very bullish, but I'm going to say it while gold is having a genuinely rough year. Again, from anchoring, from where do we measure? Here's where we're at. Gold hit an all-time record high around 5,600 an ounce in late January, pardon me. It's since traded down toward the 4,000 mark. Call it a 28 to 30% decline from the peak. ETF holders have been redeeming heavily. The technical structure looks broken. The people who are on television at 5,500 telling you it was going to 8,000 have gone pretty quiet. And yet I'm more constructive on gold today than I was at the top, which sounds kind of like the thing a guy says when he's underwater. So let me actually make the case. I'm not underwater. I'm down from my high mark. And then I'll give you the bear case in full because it isn't weak. So first, this is exactly what structural bulls do. Everyone wants to own gold in a secular bull market. Nobody wants to own the drawdowns inside of it. But the drawdowns are the bull market. Go look at 1970, which is the only real analog we have for what monetary debasement gold cycle looks like from start to finish. Gold ran hard into 1974. Then it fell roughly 47% over the next 2 years, nearly cut in half. Every single person who owned it was told the story was over. And from that low, it went up roughly eightfold over the following 3.5 years. A 28% drawdown doesn't refute a structural bull thesis. Historically, it's the price of admission to get into one. That's the thing about back tests in a structural bull, and longtime listeners have heard me say this. The back test is the entry, not the exit. So second, the marginal buyer isn't price sensitive, and that's the whole ball game. Central banks bought something on the order of 860 tons of gold last year. And the important detail isn't the number, it's the breadth. This isn't one or two large buyers. It was more than 20 institutionally meaningfully adding. Poland leading, adding over 100 ton. Kazakhstan setting a record. Brazil re-entering after 5 years away. And the World Gold Council surveys of reserve managers showed a record share planning to add more. Now, the honest wrinkle here, because I'd rather you hear it from me than find out later, the reported pace has visibly cooled. There were net sales in the first quarter, headlined by a large Turkish disposal, and reported net purchases dropped sharply. Some meaningful share of official sector buying goes unreported, so the true number is probably better than the headline. But I'm not going to pretend the reported data looked like the same it did in 2024. So But here's why I still think it's a dominant force. A central bank is not buying gold for the return. It's buying gold because gold is the only reserve asset that isn't simultaneously someone else's liability. It can't be frozen by a foreign ministry and doesn't require you to trust a government you may have been in a dispute or war with. Once a reserve manager decides that sanction proofing matters, the price becomes a secondary consideration. They buy in the dips, and they're buying now. That is a fundamentally different kind of demand to an ETF holder who bought in January because he thought it was going up. Third, the reason gold went up hasn't been fixed. It's only gotten worse. Look at the fiscal arithmetic across the developed world. Debt levels, deficits running at levels that used to be reserved for wars and depressions. And this is the part people miss. Interest expense that is now genuinely constraining. When debt service is that large, a central bank's ability to fight inflation with meaningfully positive real rates is politically and practically limited, which means the realistic path is inflation running warmer than target for longer, with real rates pinned low. That is gold's oxygen. That is the entire environment it's built for. And I'd extend it further. Gold has changed character over this cycle. It used to be a fear trade. You bought it when you were scared of an event. It's become a trust trade. It's not that you're afraid of the world, it's that you're questioning the paper promise. That's a much bigger and more durable buyer base, and it's why the correlation with real rates that govern gold for 30 years has been so much looser through this cycle. Fourth, the positioning is flushed, and that's a feature. At January high, gold was crowded, consensus, everybody on the same trade. Crowded trades are fragile because when something shifts even slightly, again, no one left to buy. That's a lot of what the last 6 months has been, a positioning unwind rather than a thesis breaking. 6 months later, the ETF money is largely left, sentiment is reset hard, and survey work has fund managers calling gold one of the most undervalued assets they track, a reading we haven't seen in about 3 years. I would much rather be buying a structural story after the tourists have left than while they're still checking in. So, fifth, and this is where I actually want the exposure, is the equities. The metal is the thesis, the miners are the opportunity. Through the run ups, the equities badly lagged the metal. The senior producers captured maybe half of gold's move, and the juniors did worse. And now on the way down, they're being hit again. So you have a group that never got credit for the upside and took the full punishment for the downside. Meanwhile, look at what these businesses are actually doing. Industry all-in sustaining costs sit roughly in the $1,500 to $1,800 range. So at $4,000 gold, the corrected, disappointing bear market gold price, these companies are earning historically extraordinary margins per ounce. Many are generating free cash flow at levels they've never seen in their corporate history. And a lot of them still trade below net asset value, below a reasonable estimate of the values of the ounces they're producing in the ground. The market is pricing in these equities as though gold is going back to 3,000. Gold's at 4. And then there's the catalyst no one is talking about. The majors have a reserve problem. Exploration budgets were cut for a decade. Discovery rates have fallen, and the average producer's reserve life is thinning. You cannot fix that with a drill program with a 2-year view. You fix it by buying somebody. So the majors are going shopping, buying ounces in the ground rather than looking for them. The consolidation wave is genuinely still early, and it re-rates the whole development in junior space when it runs. The surprise from here probably isn't higher gold, it's the miners catching the metal. Now, let me give you the bear case properly because it's not a weak case either, and I've been wrong before. The Fed is genuinely hawkish right now, and the market is pricing a real probability of a hike rather than a cut. And if we get one and real rates move meaningfully positive, it's gold's kryptonite. And it is the one macro configuration that reliably hurts it. So we might be in for a little pain. The technical picture is broken, not basing, but momentum is lower, and the charts have lost levels that now act as resistance. And it's a healthy correction, is exactly what people say on the way down in an actual bear market, and I'm aware of that. ETF outflows can continue for a long time. Retail capitulation is not a thing you can time. Reported central bank buying has slowed, and that reflects a genuine price sensitivity rather than an artifact. The single strongest leg of the bull case is weakening, and that I'm representing. And the miners are operationally leveraged in both directions. If gold falls another 20%, they don't fall 20, they fall a lot more. So here's how I hold all of that at once, and I think it's the only intellectually honest position. I don't know whether 4,000 is the low. Nobody does. Anybody giving you a number and a date is guessing with some confidence, which is the worst combination in this business. And you'll notice I'm not giving you a price target because I don't think they're a legitimate thing to hand out on a podcast. What I do know is that the structural drivers are intact and arguably strengthening. The marginal buyer is price insensitive. The positioning is cleaned out, and the equities are priced for materially worse world than the one we're in. So if you size it to survive being wrong for another year, you don't chase it up and you don't abandon it when it's down, and you take the exposure where the value actually is, which right now is the companies, not the commodity. It's not a trade, it's a position. So, what are we actually doing? So, let me put it together and what it actually means in portfolios. First principle, and longtime listeners can say it with me. In real estate, it's location, location, location. In investing, it's allocation, allocation, allocation. The lion's share of your long term return is decided before you buy a single stock. It's in the mix of sector, geography, and style. And that's where we earn our keep. So, the map right now, less crowded US beta. We're not anti-American. We're anti-overpaying for some of the most concentrated index in modern history. More of the world. International is the driver, held deliberately by region and style. Real assets in the physical layer of the AI build out. Energy, the sector's weight in the S&P is down around 3.5% against a long-term average of nearly 11. That's roughly where it sat in 2002, and 4 years after 2002, it was 8%. Left for dead, low multiples, disciplined capital programs, real cash flow, bumpy this year. The payoff is going to be 2027 and 2028 story, I feel. Gold, specifically equities, we've already talked at length. A contractual income sleeve, structured returns, and cash, not fear, optionality. Cash pays again, and it's the ammunition that lets you be the buyer when the leverage in the system unwinds into somebody else's for sale. On the fund side, I'll attribute this properly. As you know, the MLD core was ranked number one in its category over 1, 2, 3, 5 year and first quartile over every rolling period per fund data. It's not a hot streak. It's a process. It's been run through tariff shocks, rate hikes, COVID, pandemic. And I'll say what I always say. I'm not bearish, I'm selective. There's a great deal of opportunity here. What's changed is you finally get paid to be picky about it. So let's bring this back to the rodeo and get ready to close this out. The thing about bull riding is that it's not actually a test of strength. Every one of those riders is strong. It's a test of whether you can stay balanced on something that is deliberately trying to throw you off for 8 seconds. And then you have to get your hand free. And that's the market right now. 16 and a half years into a bull and ties the modern record next month. A capital spending boom so large, it is the index. Valuations that only one generation has ever seen before, and $1.5 trillion of rope wrapped around the collective hand of the retail investor. None of that tells you the ride is over. It might have a lot of seconds left. Bulls have surprised smarter people than me. But it does tell you how to sit, balanced, not leaning, anchored to your plan, and not the biggest number you've ever seen, not reacting to a feed that is paid to make you react, diversified across geographies and styles that do not all depend on one story being true, owning the real, physical, hard to replace things that the boom has to buy, regardless of who wins it, including the one that's been out of favor for 6 months. And I want more of, not less. Taking some of the return by contract instead of by hope. and knowing the difference between investing and betting in a world that spend a lot of money making them look identical to you, and above all, keeping your hand free so that when the market moves, you decide when to get off, not a margin clerk. That's it for this month. If this was useful, do me a favor, follow the show, send it to someone who's been staring at the high mark on their statement and feeling worse than their portfolio deserves. And as always, if you want to talk about how any of this applies to your own situation, um, reach out to the team. I'm Chad Larson. This is Money Matters. Take care of each other's, and I look forward to chatting with you.